Discover the tips and strategies that will help you achieve your retirement goals. I'm your host, James Knoll, and this is the podcast dedicated to helping you retire well. It all starts right here on Ready for Retirement. Hi everyone, and welcome back to another episode of Ready for Retirement. I'm your host, James Knoll. The topic for today's episode is where should you take your first paycheck from in retirement? And specifically, where from your portfolio should you be taking that first paycheck? And it's a really interesting question because it may seem simple, but it's not necessarily that simple. We spend so much time focusing on how much do we need to save and how should we invest and how do we prepare for retirement, and then retirement comes. And there's this sense of, oh my gosh, where do I actually pull money from? And specifically, when it comes to your portfolio, that sense of where do I pull money from in my portfolio? What particular fund or investment do I pull it from first? So this question is actually based upon a listener question. And the listener question is from Glenn. Glenn says this. He says, "Hi, James. This is Glenn. I love your show and listen to it every week." Thank you, Glenn. He says, "I'm a do-it-myself person, but I have a question about withdrawal strategy. Let's assume I need $100,000 to live on each year. Let's also assume I place $500,000 into savings/money market account at the end of the year that I'm going to begin retirement, so I don't need to care about the market going up and down that first year. Let's say year one passes. Now I have $400,000 left in the savings account. So I'll need to withdraw another $100,000 to replenish it to make it a full 5 years worth of savings. When should I take this $100,000 out of the market, and how many times should I do it during the year? Is this something I do all at once, one time per year, or do I do a little bit each month?" He then goes on to say, if I do it once per year, should I do it on the date I decide before retirement and just do it on that day no matter what, whether the market is up or down? If I do it once a month, should I do it on a specific day, for example, the second Monday of each month? Or should I only do it on a date where the market is up? He says this seems like market timing because no one knows what the market will do that year. All right, Glenn. Well, thank you very much for that question. This is going to be the basis for today's episode. And really the question is this. It's where do I pull money from that first year of retirement? I have some cash. I have some investments. I know how much I need. How do I make adjustments? And where do I know where to pull money from? And what's the timing of that move as I go into retirement? Before we jump into the response in the episode today, though, I want to highlight a recent review on iTunes. I always appreciate when you leave reviews. It helps more people find the show. It really helps to expand the reach of the show. And the review of the week for this week comes from username ColesDad2003. And ColesDad2003 says, "I've been listening to James for a while, and even as a novice investor, have either learned more or shored up my understanding of personal finance. In addition to providing a rough quantitative assessment, he gives his audience the qualitative issues to think through in their individual cases. He's very down to earth and lifts up his audience, which is awesome. Well done, James." And that's a 5-star review. Thank you very much, ColesDad2003. And I always love when you listen or when you leave reviews. So for those of you who have done so, thank you very much. For those of you looking for an easy way to support the show, a review on iTunes, a review on Spotify means a lot. If you haven't already done so, check us out on YouTube under Root Financial Partners. Subscribe to that channel. Just an easy, no-cost way to support the show if you've gained anything of benefit or value from the show. So thank you for that. And with that being said, let's dive into the episode. So to go back to Glenn's question, he's not saying this, but I'm assuming he's starting from the standpoint of he knows that he needs to have some money in conservative investments because he knows the market's unpredictable and you don't want to be drawing from your stock investments when the market is down. So what he's done is he has put 5 years of living expenses aside in cash, and that's the cash that he's going to live on going into retirement so that he doesn't have to worry about a market downturn. Now, here's the thing, is I would look at this in a different way. I like the idea of having money set aside in cash. I like the idea of having money in something that's going to be insulated from the stock market. But there's one I believe is a flaw in this thinking here, and I want to point that out and show you how I would reframe this to do so more effectively. Now, part of this is going to depend upon your approach to retirement income. Some people take a dividend income strategy. Some people take a total return strategy. Some people take a guardrails strategy. So there's multiple ways to create income in retirement. Really, the goal is to create the way that's most effective for you in your particular situation, both financially and in terms of just what resonates most with you, something you can stick with. And each has its benefit. Each has its place, and sometimes these can be used in conjunction with another, but I generally like to use the Guyton's guardrails approach as a starting point. I'll summarize that approach in today's episode, but if you're totally unfamiliar with it, you can actually go back to episode number 27, and it's titled, How Much Can I Safely Spend in Retirement? The goal of that episode is to outline how do you approach retirement spending using this guardrails type approach. So if you've listened to this podcast a bunch, you've probably heard me talk about this. If you are completely unfamiliar, that's a good episode to really learn the ins and the outs of it. But today what I'll be doing is giving a general high-level overview, and I like to use that as a starting point. There's many times for clients where I'll modify it or customize that approach to their particular situation, because chances are you're not going to implement it the exact same way that Jonathan Guyton outlined this in his white paper, but it's a very good starting point. It gives us some good rules to talk through. All right, so bookmark that for a second. I'm going to come right back to that. Let's now talk in general about why don't we just put all of our money in stocks every single year? Okay, so I'm going to talk with something kind of hypothetical and then bring this back to the practical of how do we implement retirement investing and retirement income. So let's look at this. Cash today, there's an interest rate of about 0%, maybe 0.5% max today with interest rates where they are on your cash investments. I'm not even going to call them cash investments, just cash holdings. Versus the stock market historically, as measured by the S&P 500, so big US stocks, have averaged about a 10% per year long-term rate of return. So hypothetical question, why don't we just keep everything in stocks and nothing in cash when it's clear that stocks outperform cash over time? Well, if stocks every single year generated that 10%, there would be literally zero reason to own cash in our retirement portfolio. Why on earth would we own something paying 0% per year when we could own something that pays 10% per year and just take our income from that thing that's paying 10% per year every single year and not have to worry about where income's going to come from? Well, it's a rhetorical question, of course. The reason we don't do that is because it's not consistent. Yes, stocks historically average 10% per year, but they don't consistently generate 10% per year. It's going to be much higher or much lower on average in any given year, but the long-term average plays out to about 10% per year, at least historically speaking. And when you're retired, it doesn't really matter what the average return is. You're not going to get, most likely, 10% per year from your stock investments. It's going to be higher or it might be much lower. So in a year where it's much lower, you don't want to have to sell your stock investments to live on that money. This isn't a perfect analogy. It's maybe not even a good analogy, but think of your stocks as almost like your salary. When you're employed before you're retired, think of your stocks as your salary and think of bonds or cash as like your emergency fund. Well, when you have a salary, when you're working, how are you paying for groceries or utilities or mortgage or vacation? Well, you're just using your salary. You're using your cash flow, and that's what's paying for all those things that you want to be buying when you're in your working years. Well, if you lose your job, though, where's income going to come from to still pay for those groceries, those utilities, that mortgage? Well, that's when you dip into your emergency fund. So kind of think of cash and bonds as like the emergency fund to your portfolio. And under this line of thinking, if stocks are going up, if the stock portion of your portfolio is growing, well, you don't really need to tap into your emergency fund. You're living on stocks. You're living on the things that are outperforming or that are performing better that year. But when stocks don't do well, and on average, the S&P 500 about 3 in every 4 years has a negative return, it's in those years where that's where you would tap into your emergency fund. It's in those years where you're not going to be living on stocks because that would require you to sell them when they're down in value. That's where maybe you're pulling from cash or bonds to live on instead. Okay, so how does this tie into Glenn's question? I know I've been kind of bouncing around a little bit so far. Let's bring it back to his question. Glenn says this. He says, okay, I've got 5 years set aside in cash. Year 1 of retirement, I pull the initial $100,000 in cash out to meet my living expenses. How do I replenish it? Well, I wouldn't necessarily pull that $100,000 in cash, Glenn, is the direct answer. It would depend upon what the market is doing. Again, I mentioned that one of the approaches I like to take is the Guyton guardrails approach. And what that does is it gives you a framework or gives you rules to operate around so that you know where should you be pulling funds from. Part of Guyton's guardrails is he has different rules where it says we don't know exactly what the market's going to do in the future. We don't know what inflation is going to do in the future. But what we do know is we want to ensure that we have enough money or income from our portfolio to last for the rest of our lives. We know that we want to maximize the amount of income we can live on from our portfolio while also minimizing the risk that we're overspending. And we want to make sure that our portfolio income is keeping up with inflation. So how do we do this? How do we do this in a constantly changing market or inflationary environment? Well, you do so by implementing some rules and having some rules of how you do pull funds out from your portfolio. Well, one of those rules in Guyton's Guardrails white paper in that framework is called the portfolio management rule. And it literally talks about where do you pull money from every single year. Well, there's a set of rules. I'm just going to read right from the white paper right now. He says this. He says, following years where an asset class has a positive return that produced a weighting exceeding its target allocation, the excess allocation is sold and the proceeds invested in cash to meet future withdrawal requirements. What does that mean, simply put? Let's say you have a portfolio where maybe you want to have, I'm just going to overly simplify this, 80% in stocks and 20% in bonds. Let's then assume the portfolio does really well, and the stocks in that portion or that portfolio particularly do really well. Well, maybe by the end of the year, that 80% stock, 20% bond portfolio now looks like an 85% stock, 15% bond portfolio because stocks did so well. They outperformed so much. Well, what this is saying is it's saying there's now an excess allocation to stocks. That excess allocation to stocks in this example would be 5% because this portfolio now has 85% stocks, not 80%. So that excess allocation would be sold, and that cash is what would be used to meet needs for your income that year. So how is this different than what Glenn's asking? Well, what Glenn is asking is he's saying, I'm going to be pulling money from cash. The assumption is those first 5 years, I'm just going to pull money from cash. Well, this rule, what it's saying is, yes, you would use cash if stocks are down, but if stocks are up, let's use money from the stock portion of our portfolio and let's pull money from there to meet our living expense needs. If stocks are up, say 10, 15, 20% in our year, well, great. Can we pull maybe 5% of that out to meet our income needs, whatever amount is required to do so? And what that's doing is it's allowing us to pull money from something that's gone up in value, leaving our cash and our bonds, aka our emergency fund for our portfolio, intact for when we actually need it. Going back to the portfolio management rule, that's part of Guyton's Guardrails approach, is the second part of the rule is he says, portfolio withdrawals are funded in the following order. Number 1, overweighting in equity asset classes from the prior year end. In other words, what he's saying here, that's so end quote, this is me kind of providing color here. If there's a return in the stock portion of your portfolio that's caused the stock allocation to be greater than what was originally intended, going back to that example, maybe stocks are now 85% instead of 80, that's where you pull income from first. Number 2, back to the white paper here. Number 2, the second place, if you can't pull money from the excess asset classes, the excess equity asset class from the prior year end. Number 2 is you pull money from the overweighting in fixed income from the prior year end. So maybe stocks don't have excess allocation because they didn't perform as well, but maybe bonds have excess allocation. So fixed income is the same thing as bonds. Well, in this case, you would pull your income from that excess allocation. So if bonds had outperformed and they had grown substantially, or even just grown during the year, that's where you'd pull income from. Number 3, if you can't pull income from either of those places, if there's no excess allocation, that's where you pull money from cash. Number 4, if you can't pull money from any of those places, you'd pull it from withdrawals from remaining fixed income assets. So start drawing down the fixed income assets. And then number 5, withdrawals from the remaining equity assets in order of the prior year's performance. So if this is a little bit confusing, all it really is kind of like an order of operations of what's the first priority of where we want to pull funds from first. Well, you want to pull it from excess equity returns or excess stock returns. In other words, if stocks have done good, pull money from those stocks that have done good or have done well, I guess, when you use proper English. Number 2, if stocks haven't performed well, then you pull money from excess bond returns. So pull money from the outperformance there. Okay. If those also haven't done well, well, then number 3, you pull money from cash. If cash isn't there, then number 4, you pull money from remaining fixed income assets, remaining bond assets. And then number 5, if all those haven't done well, then you resort, or if you don't have those, then you're resorting to pull funds from the equity positions, even if there's not excess returns. So this just gives you a framework to work through of what are the orders that I want to pull income from my portfolio. But to go back to Glenn's question, it's not necessarily just this sense of pulling $100,000 from cash every single year on a predetermined basis. Then the last part of this portfolio management rule says no withdrawals are taken from any equities following a year with negative return if cash or fixed income assets, aka bonds, are sufficient to fund the required withdrawal. Okay, so that kind of just rounds out the portfolio management rule. So why do we have rules here? Why is this even here in the first place? Well, a lot of returns, or a lot of research, I should say, about retirement income and where to pull money from, you could look at your retirement portfolio and say, okay, I'm going to definitely pull money from cash the first year, or I'm definitely going to pull money just in a proportionate way. Pull a percentage from cash, a percentage from bonds, a percentage from stocks. You could do it that way, and maybe it simplifies it for you and just you know where money's going to come from. But in doing so, you're going to have to limit how much you can spend. And the beauty of this guardrails approach is it actually enhances how much you can possibly create an income from your portfolio because you're taking a more dynamic approach. And if you're willing to operate within these guardrails, it allows you to take more money from your portfolio because you're taking it from the right places and you're almost reacting to what the market's doing, and not in a reactionary way, but you're controlling what you can control, and then you are adjusting for what needs to be adjusted. And in doing that, it's allowing you to take more money from your portfolio. Now, a quick side note here, and I hesitate to even bring this in because I don't want to make this more complicated than it needs to be, but I can sense some people maybe thinking through this thought of, well, wait a minute, James, I thought you said in other episodes, maybe you do live on cash first in those first few years of retirement because it's part of a tax strategy. You do. You can, I should say. Depending on your situation, sometimes you will definitely be living on cash first as part of your tax strategy, but this is completely separate from your investment strategy. And the quick down and dirty summary of that is if you live on cash when you first retire, what it helps you to do is it helps to keep your taxable income low. When your taxable income's low, it allows you to implement Roth conversions and fill up the lower tax brackets with Roth conversions as opposed to investment withdrawals. So in this case, when you're doing this, if it fits your particular situation, you're not living on cash because it's part of your portfolio management rule or not because of your investment strategy. You're living on cash because it's part of your tax strategy. And again, the point is to use already taxed money, aka cash, to live on, which keeps your taxable income much lower, which frees you up or frees up your ability to do Roth conversions at lower tax rates. So this is where things can get a little bit confusing because it requires you to have an understanding not just of what strategy is best for you, but how does one strategy, say your tax strategy, for example, impact other strategies like your investment strategy. So I just wanted to use this as a quick side note because I don't want to confuse anyone. If you've heard me say before, oh, well, maybe use cash to live on those first few years. Depending on your situation, this doesn't work for everyone, but depending on your situation, that can absolutely be a smart thing to do, but it's more of a tax-driven strategy, less of an investment-driven strategy. And if that tax strategy makes sense for you, I would absolutely recommend making some adjustments to your portfolio to account for that cash and to account for the fact that you are going to be living on that for some time, but there's going to be some overlap there. And that's where an understanding of how different strategies impact one another is really crucial. We can talk about all these things in a vacuum on each episode, but very rarely do they actually exist in a vacuum. And what you're doing on the tax side will certainly impact the investment side. So just a quick side note, and now let's actually get back to the investment side to see what other rules can you take a look at here. And when I say what other rules can you take a look at, this is still following the Guyton's guardrails approach here. And the nice thing about it, again, is if you have a set of rules to follow, what it allows you to do is it understands what income do I need from my portfolio? What's the best way to invest in order to create that income? But then what rules do I need to follow along the way, knowing the market's unpredictable and we need to adapt the strategy along the way to account for that? Well, the first one, the big one, is that portfolio management rule. And that's just going to determine where do you pull money from in retirement first. And we just walked through that. And there's an order of operations of do you pull from stocks or bonds or cash? And there's rules that determine that. The second rule is called the inflation rule, and this just determines the size of the annual increase in your portfolio withdrawal. In this approach, you want to increase your withdrawals with inflation. So if inflation's up 2% in a year, well, you can increase your withdrawals by 2%. If inflation's up 5% in a year, you can increase your withdrawals by 5%. Sounds pretty straightforward, nothing too complicated about this rule. The thing to note, though, is that inflation adjustments are capped at 6% per year. Now, if that sounds like a horrible rule of, oh my gosh, why is it capped? What if inflation's much higher than that? There is something called the prosperity rule, which I'm going to get to in a little bit, that does give you rules around when you can increase your income even more than that. But under the inflation rule, pretty basic rule that says withdrawals increase with inflation, but they're to be capped at 6%. Now, the inflation rule also ties into the withdrawal rule that is part of this approach. And what this withdrawal rule says is that withdrawals will increase year to year, just in accordance with the inflation rule. I'm just reading this again from the white paper, except that there's no increase following a year where the portfolio's total return is negative and when that year's withdrawal rate would be greater than the initial withdrawal rate. So let's look at an example here. Under the initial framework, under Guyton's original withdrawal rule, if there was ever a negative year, your withdrawal would be frozen. So if you happen to be taking $50,000 this year and there's a down year in the market this year, or I should say down year in your portfolio this year, well, next year you don't get an increase. Even if inflation's up 2%, 3%, 4%, you're still going to freeze, or you're still going to keep the same level of income that you had this year. You're not adding on an inflation adjustment. However, newer research has shown that as long as the withdrawal rate doesn't increase above the original withdrawal rate, then you're still good to actually take that inflation adjustment. So for example, let's assume that you started by taking a 5.5% withdrawal rate. So if you had $1 million portfolio, you started by taking $55,000 per year. Let's assume then you started and you had some good years in your portfolio, and your portfolio is growing, and that withdrawal increased with the growing portfolio. Then let's assume there's a down market and your portfolio had a negative year. Well, under the original research, you would have to freeze your withdrawal in that scenario. Under new research, though, it shows that as long as the withdrawal rate doesn't increase above the original withdrawal rate, then you're actually good to continue taking that inflation adjustment. So for example, if you started at a 5.5% withdrawal rate, but now even after a market downturn, maybe you're at a 5.3 or 5.4% withdrawal rate, you can still take that inflation adjustment. And keep in mind here, that 5.3 or 5.4% withdrawal rate, that could still be a greater dollar amount than you actually originally started with. So it could be more than that $55,000 that you started with, because you're dividing what you're taking out by the total portfolio value. So if the portfolio value has grown, then you may be taking a smaller withdrawal percentage, even if the dollar amount is more. So that's just the withdrawal rule. It's talking about when do you need to freeze your withdrawals, and it's going to be frozen, or you should freeze them, if there's both a negative return in your portfolio value for the year, and if that year's withdrawal rate will be greater than the initial withdrawal rate. In addition to this, just to get through them real quickly, there's a couple more rules. There's something called the capital preservation rule. And what the capital preservation rule is, this research, it looked at quote unquote failed scenarios. As this research was being done, we wanted to see, or I shouldn't say we, I was not part of it, Jonathan Guyton wanted to see, what is it that causes failed scenarios? Are there any rules we can implement that would significantly reduce the number of failed scenarios of various withdrawal rates? What he found was yes. And he attempted to place a rule, aka a guardrail, around spending to get retirees back on track, even in these what were originally failed scenarios, to say what changes could be made to make this a successful scenario. And this capital preservation rule, what he found was if you put it into effect when the current year's withdrawal rate, using these decision rules we're talking about, has risen more than 20% above the initial withdrawal rate. So for example, if your initial withdrawal rate is 5.5%, an increase of 20% doesn't mean it goes to 25.5%, it's 20% of 5.5%. So in this case, if your initial withdrawal rate goes from 5.5% to above 6.6%, what you'd have to do is implement the capital preservation rule. What that's telling you is you're starting to spend too much into your basis, too much into your principal. And when this happens, then the current year's withdrawals need to be reduced by 10%, and the rules are then applied to that new number as a baseline going forward. So it's a way of keeping your withdrawal in check if it starts to creep up too high because of a result of not great market conditions or above average inflation or a number of things. It's a way of saying, let's put a rule in place that's going to minimize the number of failed scenarios. Now, the good news is there's also a prosperity rule. So the capital preservation rule does not sound very fun. It says, oh, I don't want to take a pay cut in retirement, but there's also a prosperity rule. And the prosperity rule is the opposite of the capital preservation rule. It says if things are going really well, Well, don't limit your spending unnecessarily. And the prosperity rule says if your initial withdrawal rate falls 20% or more below the initial withdrawal rate. So if your 5.5% withdrawal rate turns into 4.4% or lower, which again doesn't mean you're spending less necessarily, it could just mean that your portfolio value is increasing. So what you are taking out as a percentage of your portfolio is actually falling. Well, if this happens, then you can increase this year's withdrawals by 10% and use that new number as a new base. The good news overall is that in all these tests that were run, you tend to use, or the research tends to implement the prosperity rule a lot more often than the capital preservation rule, which means if you follow these, yes, there will likely be times where you may need to cut back a little bit, but that's more than offset by the number of times that you can increase your spending a little bit. So why did I go so into those rules today? I know that wasn't probably the basis of the original question that Glenn asked. I did think that it was appropriate to go there because so often we look at retirement and we want a fixed plan. We want to know exactly where money is coming from. We want to know exactly what to do. And in some cases you can do that. But the nice thing is in retirement, it's really difficult to know exactly where you'll pull money each year. It's really difficult to know exactly how much you'll be able to spend in future years based upon increases or decreases in the market or inflation or other factors. It's really difficult to know what market conditions will be and how should you change your portfolio based upon current market conditions. Well, in this scenario, using this type of an approach, you really don't need to change your portfolio a whole lot based upon current market conditions. It's meant to be in some ways a quote unquote all-weather portfolio where if you set up the right portfolio, and by the way, in Guyton's Guardrails approach, he tests 3 different portfolios. So it's not like there's even just one way to implement this. There are multiple ways. But in this, if you implement this approach, it gives you the freedom from having to stress too much upfront of exactly where money is going to come from, year 1 or year 5 or year 10 or year 20. You just follow the rules. It allows you to not have to worry about current market conditions and how should we change what we're doing. Well, you probably shouldn't. If you implement the right portfolio up front, you change where you're pulling from and you're changing the adjustments that are made, but it gives you the framework to operate within to have that successful retirement where you know where to pull income and how income can be changing over time. So I think at the end of the day, the reason that you implement something like this can best be summarized with this line from Guyton's white paper, where he says, and I quote, "Our analysis using Monte Carlo simulations supports the conclusion that the application of a few simple but powerful decision rules can significantly increase maximum initial withdrawal rates while virtually eliminating the possibility that a quote unquote perfect storm could cause a retiree to run out of money," end quote. So again, the reason I like to talk about this so much is because just the question on so many retirees' minds is how can I maximize what I can do in retirement while also minimizing the threat or minimizing the risk that I run out of money or that something bad happens and causes me to run out of money or take a significant hit to my standard of living. So instead of looking at retirement as such a fixed or rigid thing, if you apply these rules, if you apply a more dynamic approach, it allows you to accomplish both of those tasks. So Glenn, I really appreciate the question. I think this was a good chance to really dive into some of the details of this rule, of this framework. There's of course a lot more details to this, but wanted to summarize what I believe to be the most important aspects of it. So thank you, Glenn, for the question. If you are listening and have a question, you can always submit that by going to the Ready for Retirement website at readyforretirement.co. There's a page called Submit Your Question. Thank you, everyone, as always, for listening, and I'll see you next time. Thank you for listening to another episode of the Ready for Retirement podcast. If you're enjoying the show, please subscribe and let me know by leaving a 5-star review. And as always, for a list of the notes and the resources mentioned in today's episode, you can find those at the Ready for Retirement website, which is readyforretirement.co. That's readyforretirement.co. And if you have a question that you would like for me to answer in a future episode, then you can also go to the Ready for Retirement website, readyforretirement.co. There's a page called Submit Your Question where you can submit a question for me to answer in a future episode. Thanks as always for listening, and I'll see you next time. Hey everyone, it's me again for the disclaimer. Please be smart about this. Before doing anything, please be sure to consult with your tax planner or financial planner. Nothing in this podcast should be construed as investment, tax, legal, or other financial advice.